Welcome to a video that I like to call the deep dive video, and I feel I need to explain this right off the bat. I don't want this to be counted as some kind of clickbait. Every week I do a number of videos. I do a video each day, I do a weekly video, I do an intermarket analysis video, and I try to only use the charts in those videos that are actually telling us something right now. At the end of the week, I take all of the charts that I didn't use and I put them into this video because sometimes we can still get some insight by looking at these charts that may not be glaring at us with something that we're looking for, but we can still get some insight anyway. There are also some additional charts that are exclusive just to this video. This is being prepared for Monday, January 22nd. The first is exclusive to this video. What you see here is a 50-period moving average of the VIX. The VIX is on here, but then it's made invisible, and over top of that is the 50-period exponential moving average. This helps us to determine the dynamic range of the VIX. Usually, the VIX has what are static numbers attached to it, 12 to the downside, 20 to the upside. Well, you can see by how this moving average goes, we don't always stick within that range. It is more dynamic. And there are times when we go up into a higher range for the VIX. There are other times when we go into a lower range. This is a fear gauge. The higher this goes, the more fear there is in the market. When this goes down, that means there's less fear. We can look way over on the right-hand side and see that we could be establishing a lower range as the market has been improving in 2023 and kind of so far into 2024. Also, and I did show this one time this past week in the daily video, I like to measure how fast the VIX is going by using an RSI indicator based on 9 periods. We did get almost up to an extreme reading. That means the VIX was going up. And remember, this is a fear gauge, so this goes up when fear is increasing. Earlier in the week, we were starting to turn more negative. Now, in Thursday and Friday session, we started to bounce back, and we set an all-time high with the S&P in Friday's session. But before that, it looked like, oh no, we could be getting quite negative here, and we were just barely giving an extreme reading with this indicator. But then as the market was going back up, we saw the VIX start to come back down. This is another study that we do. We look at the VIX, and that measures the volatility of stocks. Well, on top here, we have the MOVE index, and it's a relatively new indicator. It hasn't been around all that long, so doing historical studies on this has been rather challenging. This measures the volatility of bonds. So we can get kind of on one chart here a look at how is the volatility looking between the stock and bond markets. What I pay attention to is mostly on the bottom. It's the correlation between the top chart and the middle chart. Right now, we're just about in neutral territory, meaning that bonds and stocks are not necessarily going volatility-wise in the same direction at the same time. Then this is another study that sometimes I use quite a bit. Other times I go an extended period of time and I don't use it. This is a VIX to S&P 500 correlation. Sometimes when we spike up and then start to come down, that will mark some kind of move in the market, usually a downward move. We did see a spike up here recently, and then we saw a little bit of weakness that doesn't seem all that pronounced on this chart. But if you were following it during that time, you took note of that as 2024 was getting started. But right now, we're dropping back down with this correlation, so I haven't been showing this chart. Then we look at another variation of the VIX called the skew index, where the VIX looks at the-money options to do its calculations. The skew index looks at out-of-the-money options to calculate its results. And sometimes when we get up into this red area, that means the market is expecting some kind of a big move. You can look at other times when we spiked up and then started to come back down with the skew index. Sometimes the market kept going up. Sometimes the market kept going down. Sometimes it marked a top. Other times it marked a bottom. So we have to look at other charts to get some context for this particular indicator. We also measure fear using things beyond the VIX. I look at a 3-month or 3 to 7 year bond ETF, and then take a ratio of investment grade bonds. And typically when this is going down, that means fear is decreasing. Well, as we were starting 2024, we started to see fear go back up, then come down, then go back up. And we've really been chopping around sideways with this particular fear gauge, so I haven't been showing it all that much. Another fear gauge that we look at are shorter term bonds with the equal weight S&P 500, and then taking a ratio. And as stocks were going up later in the week, this was also declining. Overall, this has also been declining, which kind of confirms what we've been seeing in the VIX longer term. Then I used to show the retracement. How far below are we from the all-time high? Well, in Friday's session, we set a new all-time high. So now we're 0.44% above the past all-time high, as the S&P is setting a new all-time high. Technical alerts are put out by stockcharts.com. These are automatically generated, and I look at them not only individually, but then in total. And this is for the whole week, and we read this from the bottom up. When they're red, that's negative, and earlier in the week, we were looking more negative. In Tuesday and Wednesday session, we were closed for Monday. And then Thursday and Friday, we were turning back more positive, and you see a lot of blue or green here. And then at the very top, this was the last signal to be triggered when the NASDAQ crossed above 15,300. So this just kind of gives you a look. When you take all of this together, are we more positive or negative? But then we can also look at the individual triggers to see what's happening, not only in the S&P, but at different sectors and as well as different indexes. Then we look at a number of different indexes. And of course, everything that I do and I teach about and strategies that I implement and teach as well are based on the S&P 500. But the S&P 500 does not exist in a vacuum. It's influenced and impacted by other indexes. And so we also look at the Dow, that's the 30 blue chip companies. We look at the NASDAQ 100, which a lot of the stocks in the NASDAQ 100 are also included in the S&P 500. The S&P 500, of course, the mid caps and the small caps, to get some kind of an idea of how are things looking right now. Stockcharts.com rates these on a scale of 0 to 100. The higher the score, the better looking the chart. And coming in first place right now are the QQQs, which is the ETF for the NASDAQ 100. And it's showing some improvement as it's now also setting a new all-time high after Friday's session. And the score is coming in at 96.1. In second place is the S&P 500 as represented by the SPY. This is the ETF for the S&P 500. And it's coming in at 86.8 and showing some improvement when we look at the historical values of this particular indicator. In third place is the Dow, also looking a little bit stronger, but it has been trailing off a bit. It comes in with a score of 85.2. Then we have the mid caps, which are showing some improvement. They had been getting quite weak. They dropped under 40, but in Thursday and Friday's session, they were starting to show some strength. So they ended the week with a score of 57.8. And then in last place are the small caps, as represented by the IWM. That's the Russell 2000 small cap ETF. And this was getting back down into the low 20s before turning back up and now giving us a score of 31.5. The small caps have been a real disappointment. There's a thing called the January effect, which usually starts in December. And we saw that happen. And then it's supposed to carry over into January. Well, it just hasn't been happening. And you can see how this score has changed. We were down into the teens. And then we started to get into December and we got all the way up to a score of a little bit over 90. That's really healthy and that's looking technically strong. But then we started giving these gains back and we dropped all the way back down to about 20. Now we're starting to turn back up. We're wondering, is the January effect going to resume or is this just a little blip? Because what we've been seeing with the small caps is they shoot up and then spend the next 3, 4, 5 days giving a lot of their gains back, shoot up again, give back the gains. It's been really frustrating to invest in the small caps. Then some short-term charts. This is a rainbow. And even though this is a short-term chart, I try to look at this chart all together from the left side all the way over to the right side. And this is a rainbow where we measure moving averages from 10 periods up to 50 periods. And then I change the color of the line so it kind of looks pretty cool. But on a short-term basis, you can see where all the lines are going up and prices above all of the lines. So this is suggesting that the short-term trend is positive, and you can also see where the S&P did set a new all-time high. Then we have a thing called the boom indicator, and I developed this decades ago. I just gave it a name a few years ago because the idea behind this is that price won't get too far away from a moving average. The moving averages that we use is a 20 period, 50 period, and 200 period. When price gets too far above or below a particular moving average, it'll have a tendency to boom back or snap back to the moving average. It acts like a rubber band or a magnet. And so we can, on a short-term basis, look at when we're extreme on a 20-period moving average, and we're going up, but we're not extreme right now. We were not too long ago, but we're not at this point. We're also looking more positive with the 50-period moving average, and we're looking a little bit better as well with the 200-period moving average, but none of these are looking extreme right now. And some intermediate term charts, another rainbow going from 50 periods up to 100 periods. And we're seeing the lines start to kind of even out and go higher here as price is above all of the lines. So the intermediate term trend is still positive. Then we have another interesting study where most moving averages you base on the close, and then you go back 20 periods, 50 periods, 200 periods, and then calculate the moving average that way. Another development has been a thing called the anchored moving average, where you can go to a previous high and then run the moving average forward. And this can quite often act as really good support or resistance if we're hitting that with price. Last October, we started to go down below this anchored moving average, but then we were able to come back above that. And now, since we're continuing to go up with the S&P, I have stopped showing this chart since we're far away from this anchored moving average. Then we have another oscillator called the Connors RSI. If you're familiar with the regular RSI, it measures momentum as well as overbought and oversold indications. And that's what the Connors RSI does. When we're above the midpoint and going up, that's positive. Below the midpoint and going down, that's negative. And then we look for extreme positive or negative readings to give us overbought or oversold indications. Right now, we're positive and not getting an extreme reading. This is pretty spastic, and it moves around quite a bit, but we don't get an awful lot of extreme readings with this indicator. We've been really following the 20-period moving averages. That acted as support. We started to fall down to the simple moving average and then the exponential moving average. And so far, it's been successful as we've bounced up off of that. In the background is also the 50-period moving average, which would be the next layer down, logically, based on technical analysis. If we had fallen through the 20-period moving averages, we would then start to look at the 50-period moving averages. And on this chart, I have both a simple, which treats all 50 periods the same, and an exponential moving average, which weights it more towards more current prices. When the blue line is above the red line, that means the trend is more solid and we're going up, because the exponential moving average, which is blue, it tends to move faster than the simple moving average. So not only are we above both of these lines based on price, which is positive, and these lines are going up, which is positive, we're also showing that the trend is pretty strong because the blue line is above the red line. We also look at a 100-period moving average, which would be the next level down if we fall through the 50-period moving averages. Right now, they're looking more positive. The red line is above the green line because the exponential is moving faster than the simple, and price is well above both. Then we want to see how far away above or below are we from the 200-day simple moving average. And this is kind of interesting. I'm not sure if we should read something into this or not. Probably not. But it's just something I noticed when I was looking at this chart. We are positive, and we're setting a new all-time high. But also notice that we haven't exceeded the previous high set back in July of 2023. Now, that's probably not a big deal because the 200-period simple moving average is going up and up and up and up as well. And so it's a little bit closer to price, even though we're setting a new all-time high with the S&P 500. So this may look like a negative divergence, but really it's more positive than negative in my personal interpretation. Then we look at standard deviation. This doesn't measure direction. This measures speed, and we're still pretty low going over the last 10 periods. Yeah, we've broken out to a new all-time high here, but we have spent a lot of 2024 just chopping around, and that's why we're getting a pretty low reading as far as standard deviation is concerned. Whether it's an index or a stock really starts moving, we'll see the standard deviation spike up above the moving average. Then we have a CMB composite. This is supposed to be a standalone trading system, but I use this like an oscillator. We look for extreme positive or negative readings, and right now we're not getting anything, so I haven't been showing this chart. The mass index is not generating a signal right now. When the line comes up and hits the red dash line and the blue line, that's when some kind of signal is triggered, and we're far away, so I've been ignoring this chart. Then we not only hit an all-time high with the S&P 500, we also hit an all-time high with the S&P 100. So they are confirming each other, and they're both reaching all-time highs at about the same time. This is just a measurement. When we hit that high back in July of 2023, and then we really started to go down and we hit a low in October. This just measures how far we've gone up since that time, just to give us a reference point. Then this is a point and figure chart, which does not take time into account. When we go up by a certain amount, an X is drawn. When we go down by a certain amount, a 0 is drawn, or an O. And even though we're hitting an all-time high, we did not see a new X drawn in here yet. Apparently, we haven't moved quite enough to have a new X be generated here. And there's also a signal called a double top breakout, which was generated on the 20th of November. And that's a positive signal as well. So this chart, and we can see the trend lines underneath here, that's also suggesting that things are positive. Then we have the Pring bottom fisher, which is pretty good when we're really going down and we're trying to figure out, is the market finally reaching some kind of a bottom? Well, since we've been going up, this indicator, it was going up too, trying to give us a signal, which really didn't seem to help all that much. Now it's starting to go back down. It's pretty much an irrelevant signal at this point. Some long-term charts, we start with another rainbow going from 50 periods up to 250 periods, and we're above all of the lines on this rainbow chart as well, and the lines continue to go up. So the long-term trend is also still positive. We also have a thing called the daily special K. This is a long-term oscillator. I mention this in every daily video, but I don't show the chart because we don't get very many signals from this. When we're above this red line, that means we're more positive. If we drop down below it, we are negative. We continue to be positive above the red line. Then I'll probably stop showing this chart too. Most of the charts that we look at are based on a log scale. Well, you can also change that a little bit and use the arithmetic, and you can be all fancy and try to say arithmetic, but it's arithmetic. It's what we took in school. And this just measures a long-term trend line, and where are we in relation to that long-term trend line? And we're well above it, setting a new all-time high, and we're far away from this trend line for right now. Then we look at a weekly chart of the S&P on top and a weekly chart of the German DAX. The German stock market and the economy, that's the biggest in the EU. And we look for correlations between the two, and we look down at below, and we can see when this has a high reading, that means that the German DAX, which is their version of the Dow or the S&P, and the S&P 500 have a really strong correlated relationship. Doesn't tell us the direction. They could both be going down, they could both be going up, but they're having a tendency to go in the same direction at the same time. Then we also look at another kind of interesting study where we take the 10-year yield of the US bond and we subtract the 10-year yield of the German bond. And since US rates are higher, that gives us a positive result. Hence, we're above this red line. That's the 0 line. And sometimes when we put the US dollar index down in the middle area, we can see a pretty high correlation between the two, but we're not seeing that right now. You can see where the correlation indicator here is really dropping off, and we're actually closer to going in opposite directions right now. So this chart really hasn't been helpful to us. Then we have some different support and resistance levels, as well as Fibonacci levels and line studies that I do. This is a quadrant study where I go from the COVID low to the previous all-time high and just chop these up into 4 chunks here. Well, now that we're starting to break out above this, I'm not quite sure what's going to happen with this chart. I'll still keep it, but now we're waiting for some new things to end up happening and some new line studies to be created that have yet to reveal themselves to us. This is a 50-day cycle. We did start a new cycle on January 2nd, and it looked like, okay, maybe this cycle is going to go down, but now we're turning and starting to go back up. Sometimes a 50-day cycle can be useful. There's folks that use a 7-day cycle, a 16.5-day cycle, a 123, whatever you want to come up with. It just seemed like when we were running into a lot of problems in 2022 and into 2023, the 50-day cycle did a pretty good job of measuring tops, bottoms, or at worst, continuations of what was already happening. I don't know if this is really all that useful now. We may switch to a different kind of a cycle since the whole market environment is changing. You kind of just have to do this by trial and error to come up with something that works. Fibonacci retracement levels, we're now exceeding the previous 100% retracement level. So at some point, if we top out and start to come down, some new Fibonacci lines will need to be drawn. We're also seeing this with our longer term Fibonacci chart here as well. The NASDAQ still has not made an all-time high yet. The NASDAQ 100 has, but the NASDAQ has not. This still has a ways to go to get back to its all-time high. This is the Ichimoku cloud. A lot of folks use these and they're popular, especially if you do foreign exchange type trading, where all this is a series of moving averages that are based on current prices and then shifted forward. And sometimes these clouds may act as resistance when we're coming up. They may act as support if we're coming down. Right now, we're well above the clouds, so I haven't been including this chart. Some broad market measures. Here's the NASDAQ 100 also breaking out to new all-time highs. So eventually, at some point, the Fibonacci lines will have to be redrawn. Also keeping an eye on the financial sector. We were really showing some weakness throughout 2022 and into 2023. This level of support had really been holding. Well, now we're bouncing well up off of that. We're far away from it, so I haven't been showing this chart. Then we look at the Vixen, which is the VIX for the NASDAQ 100. I don't really use this middle chart here because of all the erroneous data. If anything, I look more at the line chart, and this measures how much fear is in the NASDAQ 100. And as it's been going up, we've been seeing fear starting to decrease. Then we take a ratio between the S&P 500 on top, and we compare that with a ratio of the Qs to the Dow Jones ETF, and we can see that they have a fairly strong correlated relationship with each other. Looking at the banks, they really took a dump last March when we had the banking crisis, went sideways, and now have been starting to show some improvement, enough to give us a golden cross here as far as the trend. And here's the regional banking ETF, which had been showing some improvement compared to the financial sector. But since earnings started to come out, and we've been seeing this come back down to its 50-period moving average, and it's trying currently to bounce up off of that after recently generating a golden cross with this ratio. Some rate of change charts. These are just informational. We take Friday's close and go back 250 trading periods, and we're starting to tick back up slightly. Another longer term chart going back to 1980 just kind of shows where we're at in the bigger context. Then keeping an eye on bonds, where we look at the S&P 1500, which is a broader market measurement, and comparing that with shorter term bonds. When this is going up, that means stocks are outperforming bonds. And then this measures the 1 to 3 year treasury bond, shorter term, and compares it with 3 to 7 year bonds. And when this is declining, that means that interest rates are becoming less of an issue. So it's that since June, the shift has gone back to rising interest rates. When this is going up, the market's more concerned about interest rates going up. When this is coming down, the market is more convinced that interest rates are going to come down. Now we're starting to go back up. And in 2024, we've seen interest rates start to rise again. We're keeping an eye on that. In Thursday and Friday's session, interest rates were up and stocks were up as well. At some point, something's going to have to give. Either stocks are going to have to go down if interest rates keep going up, or interest rates are going to have to fall to help give stocks more support. We also look at an inverse of that same kind of thing. We look at the 7 to 10 year bond and the 3 to 7 year bond ETF. When this is going down, this tends to mean that there's a little bit of uncertainty about interest rates right now. When this is going up, the market is more confident that the Fed might be completely done. Then we look at a ratio compared with the S&P 500 with the long-term bond ETF. And based on 50 periods, their correlation is pretty strong. We're getting a pretty high reading here. When we base it on a shorter term relationship, we're seeing where bonds and stocks are deviating from each other right now. And that's kind of what we're seeing these days. Not enough to really jeopardize the longer term relationship. And this may be short term and start to rectify itself fairly soon. Then we do a ratio between the QQQs, the NASDAQ 100, and the long-term bond ETF. And they're having a pretty strong correlated relationship currently. Then this is the yield curve spread that we measure here. And when we're below the red line, that means we're inverted with the 10 to the 2 and the 10 to the 3 month. These are the two important ones. When these finally go back and be regular again, because I think the 10 to the 2 year, it's been inverted for almost 2 years now, where the 10 to the 3 months has been inverted for about a year and a half. We're just waiting and watching this every day. When they go back to being regular, that usually starts a countdown to, are we going to head into a recession? So we're just waiting for that to happen. And there's evidence to suggest that we may go into a recession. There's also a lot of evidence to suggest that we won't. So we just kind of have to take things as they're presented to us. Then we look at 3 to 7 year bonds and compare it with stocks. When this is going down, that means that bonds are underperforming. To say it another way, that means that stocks are outperforming bonds. Then we look at the 1 to 3 month T-bill, which you could call cash, and we compare it with further out bonds. And when this is going down, that just means that there's more confidence that interest rates are coming down, but you notice this is starting to go back up right now as the market's getting a little bit nervous about what the Fed is going to do with interest rates. Then we look at a thing called TIPS. These are Treasury inflation protected securities, and we compare them with bonds. When interest rates are climbing, folks want to get into TIPS because you can roll them over and they adjust for inflation or interest rates. When interest rates are coming down, then folks want to get into longer term bonds. This has been chopping more or less sideways recently as the market's kind of undecided what it wants to do. But as this is going down, that means that inflation worries are starting to subside, and it still is in a downtrend. Then we look at TIPS and then look at further out bonds where this had been really declining more pronounced than on the previous chart, but now it's starting to go back up as folks are a little bit concerned about what's going to happen with interest rates. Then we look at home construction, which is a very interest rate sensitive part of the economy. And if we look at this ratio and we compare it to bonds, if the housing construction market was concerned about interest rates, we would not be breaking out to an all-time high with this ratio. So at least in this part of the market, folks are not all that concerned about interest rates. Then I have a thing called the possible positive scenarios. This was developed mainly when we're going down and to look for different signs that can signal that we might be at some kind of a bottom. But these charts are also useful when we're going up and we can tell what's happening more or less in the market. A lot of these I use in the daily videos. Well, some that I haven't been using lately are the percent of S&P 500 stocks above their 200-day simple moving average. And we had gone up as stocks were going up at the end of 2023, but now we've been starting to fall back recently. Then we look at that same kind of study, but we look at the 50-period moving average. This had actually become extreme positive and was starting to come back down, but over the last couple of days, it started to bounce back up. We look at that same basic study with the mid caps, getting extreme, falling down, starting to bounce again, and small caps getting extreme, falling down, starting to bounce back up a little bit. So we are seeing some improvement across the market. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a great weekend, and I will talk to you in the next video.